We are back with John Zechner, chairman and founder of Zechner Associates. We are talking on the radar. Certainly, oil has been on the radar of Canadian investors, particularly as it continues to hamper the performance not only of the TSX, but definitely those oil producers. The TSX oil producers trading at the lowest level since July, basically mirroring this chart that we're looking at right here, which is the oil price. What do you think, John? Are these energy producers, I know from time to time they're on your radar, are they on it right now?
Absolutely. Yeah. I was in here talking a couple of weeks ago and I said we were getting out of the economically sensitive areas and oil was one where we cut our exposure. I'm turned around today and I'm probably looking at buying back almost all of the stocks that we sold because they've dropped so dramatically. And I just think, no, you're still talking about at current oil prices, 10% plus free cash flow yields, 3 times operating cash flow, more shareholder friendly activities for them in general. Consolidation in the sector. You saw another U.S. takeover this week.
Yeah.
So, that will continue. And yeah, I mean, I haven't seen a breakdown in the demand for oil. I mean, you will because the economy is slowing down, but you still have supply constraints going ahead. The biggest factor, and I was listening yesterday with Eric Nuttall on with John, and I mean, his point is absolutely right. The biggest players in the oil market right now are the financial players. And, they have gone extremely bearish. I mean, their net short positions in oil, I think, are at record levels again. I think that drives a narrative, and that just certainly drives the oil price in the short term. I don't think it's real. I think down here at $70, I think oil is undervalued on a supply-demand basis and a physical basis, not a financial basis. And the stocks are very cheap.
What about the argument that production discipline isn't that disciplined at all? Fine, OPEC Plus and Saudi can do what they do, but there's other producers that are pumping and some at record levels, including the U.S. U.S. is back to producing at record levels.
Yeah, they are. Now, correct me if I'm wrong, the way I understand, a lot of the U.S. data, particularly on the shale side, they revised how they measure the U.S. data this year. They started including natural gas liquids. So this, million-plus gain in production is not really all there. Some of it is a recategorization. You're right. You'll get production creep from other places, but in the end, the productive capacity it's just not that strong. Maybe it's okay in an economy, global economy that's not growing and flat, which is what we're looking at maybe for the next year. But ultimately, yeah, there is a shortage. And, at $70, the shale guys, you know what they did? They'll start to slow it down again. So I think you've also got a floor on the oil price.
The energy producers themselves, and I want to compare it to the gold sector, obviously it tracks what happens in oil, but oil's down 15%, but the oil producers, not the TSX Energy Composite, but the producers as a group are up 6%. So they managed to outperform their underlying commodity, which is not something we typically get from the gold producers.
No, but, it's a point-in-time thing, Amber, because you sort of look at it on a longer-term basis. I think they've lagged the upward move. How are oil stocks today versus 5 years ago versus 15 years ago relative to the price of oil? And I'd say, 3 times operating cash flow.
They're up. They've outperformed.
They're up, but is their valuation expensive? Right. And I'd say no. I'd say it's at the lower end. Traditionally, it's been, as gold has been. and that hasn't changed. I mean, when I got into the business, gold stocks used to trade at 2 to 2.5 times net asset value. Now they trade at a discount to net asset value. They'd be mid-teens cash flow multiples. Now they're 4 times cash flow multiples. So yeah, that's a flow of funds argument, and I think that is probably a bigger problem with the sector in general. Is you've got all these ESG funds and others on a global basis that are just moving away from fossil fuels altogether. So it's shrinking the market of potential buyers, which I think is why you'll see more corporate activities. If investors aren't going to buy this, these guys are going to buy it themselves.
Just name drop a few names in the oil sector that you're looking at.
Baytex and Crescent Point to me top of the pecking order, more oil orientation as opposed to natural gas, recent acquisitions, and cheap.
Okay.